Engine maker Rolls Royce has announced one of the biggest losses in British corporate history. Its pre-tax loss of more than $5.8 billion last year was the largest it has ever suffered. A bribery settlement of more than $800 million and the fall in the value of the British pound since the Brexit vote last June took their toll. But it's not all bad news. Excluding the effects of the settlement and currency, underlying profits fell by 49%. That sounds like a lot, but it's much less than analysts had predicted. Rolls Royce Chief Executive Warren East says difficulties in its marine business are likely to continue, but he still expects to report what he described as marginally higher revenues in 2017. For more on this, Mike Ingram joins us now live from London. He's market analyst at BGC Partners in London. Mike, thanks ever so much for joining us once again. Let's look at that headline once again from Rolls-Royce. Quite alarming it is. And yet a lot of people in the city don't seem too concerned about Rolls-Royce right now.
Yes, indeed. These are eye-watering numbers. As you said, one of the largest losses ever booked by a corporate in the UK. But the vast majority of this is effectively an accounting issue. It's to do with their enormous hedge book. It's approximately $49 billion hedge book. Most of their revenues are booked into dollars, and the company hedges this out because a lot of its costs are in sterling. Now, of course, due to the devaluation of sterling post-referendum, they are now obliged to book this loss. But it is a paper loss. It's not a write-down. It doesn't impact cash flow. And of course, over the longer term, given the currency exposure of the company, it's going to be a net beneficiary eventually of weaker sterling. So a lot of these losses, these paper losses, is booking up front now, are going to be written back through the profit and loss account in future years. In terms of the underlying profitability, which you mentioned, it was about a 20% beat on what analysts had penciled in for this print. I suppose you'd have to say that expectations were pretty low. I mean, this company has posted, to my reckoning, 5 profit warnings over the last 2.5 years. Yeah. But I think the reason why the share price was...
There are problems still ahead, though, for Rolls-Royce. Earlier we spoke about Toshiba pulling out of nuclear projects. And that is actually having a knock-on effect on Rolls-Royce itself, because they were hoping to develop these so-called modular nuclear reactors with Toshiba, one of the nuclear plants in the UK likely to be affected by all of this. Problems ahead then for Rolls-Royce?
Yes, indeed. I mean, yes, it was a beat this time round, but I think the market was certainly disappointed by Warren East's prognosis for 2016, only marginally higher profits. I think the market was looking for something like a 15% increase in 2017. They're going to have to take a red pen out there. And if you look at the divisional performance within Rolls-Royce, every single division, whether it was nuclear, power, civil aeronautics, defence aeronautics, and the marine division, all showed some of them substantial drops in profitability. And we know, for instance, the marine division is suffering in a lower oil pricing environment. We know at the moment, in terms of its aeronautics divisions, it's really stuck between not selling any of their new jet engines yet, and yet they're still facing declining revenue from servicing their older models. So they're in a tough spot at the moment, and I think the market is right to be sceptical, and probably one of the reasons why the share price was marked down somewhat today on the back of this print.
Great. Mike Ingram, BGC Partners in London, thank you ever so much.